Welcome to Tuesday, June 24th, 2025. Global financial markets have been volatile and highly reactive, driven by shifting geopolitical events, especially the Israel-Iran conflict, and diverging central bank policies. Equities, particularly U.S. technology stocks, led gains, initially boosted by reports of a Middle East ceasefire. However, this optimism was quickly challenged by renewed conflict headlines, highlighting markets' extreme sensitivity to geopolitical news. Major global equity indices posted gains, with U.S. tech stocks rebounding strongly. The initial ceasefire news between Iran and Israel sparked a surge in risk assets and a drop in oil prices. However, subsequent escalation reports reversed some of this optimism. Despite these swings, equities showed resilience, likely underpinned by optimism around artificial intelligence and expectations of future monetary easing. On the bond side, U.S. Treasury yields remained relatively stable, with the 10-year yield around 4.35% and the 2-year at 3.84% as of June 24, 2025. However, recent Treasury auctions, especially the 20-year bond, revealed weak demand, bid-to-cover ratios fell, and foreign participation dropped. The Federal Reserve had to covertly intervene, buying $20 billion in 3-year Treasuries to stabilize the market, signaling hidden liquidity pressures and raising concerns about the sustainability of U.S. debt financing. In the currency markets, the markets were shaped by diverging central bank policies. The U.S. dollar's performance was mixed. The Japanese yen weakened further due to the Bank of Japan's dovish stance and widening yield gaps with the U.S., overriding its traditional safe haven status. The Swiss franc strengthened, prompting the Swiss National Bank to cut rates to zero to combat deflation and limit currency appreciation. The euro and pound gained modestly, while emerging market currencies outperformed developed peers. On commodities, oil prices were extremely volatile, with Brent crude dropping to around $69, reflecting the market's sensitivity to Middle East developments. Any ceasefire or escalation headlines caused sharp price swings, as the risk of supply disruption through the Strait of Hormuz remains high. Gold, typically a safe haven, saw a short-term dip despite geopolitical tensions, but its longer-term trend remains bullish due to inflation concerns and expectations of global monetary easing. Regarding liquidity, money market funds in the U.S. continue to grow, reflecting investor preference for liquidity and safety amid uncertainty. The M2 money supply has reached record highs, growing for 9 consecutive months, indicating ample systemic liquidity that could support asset prices but also fuel future inflation. Regarding liquidity, money market funds in the U.S. continue to grow, reflecting investor preference for liquidity and safety amid uncertainty. The M2 money supply has reached record highs, growing for 9 consecutive months, indicating ample systemic liquidity that could support asset prices but also fuel future inflation. On the options side, unusual options activity suggests institutional investors are positioning for volatility and potential corrections. Northern Trust stock rose on merger rumors, but bearish options flow suggests skepticism about the deal. SMC stock and options both turned bearish after a convertible note offering, signaling dilution concerns. Circle, despite strong post-IPO performance, heavy put buying indicates hedging or expectations of a pullback. On Nvidia, options market is split with both bullish and bearish flows, reflecting high volatility and uncertainty. Other notable moves: Exelixis surged on positive drug trial results. Him and Hers Health fell after a partnership ended. Tesla rose on its driverless taxi launch. Tata Capital's IPO is set to be India's largest in 2025. Geopolitical risk is the dominant market driver, especially in oil and equities. Central bank divergence is creating opportunities and risks in currency and fixed income markets. Liquidity concerns are masked by surface stability, with the Fed's covert interventions highlighting deeper fragility. Money market and M2 growth point to ample liquidity, supporting asset prices but raising inflation risks. Expect continued volatility, especially in oil and equities, as geopolitical headlines evolve. Central bank communications, particularly from the Fed, will be crucial for market direction. Treasury auction demand will be a key indicator of confidence in U.S. debt. Currency moves will hinge on central bank policy divergence, with the yen likely to remain weak and the Swiss franc potentially softening if aggressive easing continues. Overall, markets are navigating a complex, fast-changing environment shaped by geopolitical tensions, diverging central bank policies, and underlying liquidity dynamics. While equities have shown resilience, this is fragile and headline-driven. Bond markets reveal deeper structural weaknesses, masked by short-term stability. Central banks are increasingly independent in their policy paths, creating both risks and opportunities. Investors should remain nimble, monitor key developments, and be prepared for further volatility. Review the daily global financial dashboard below.